Hey investors, so markets closed today, right? So perfect. You know what that means for us investors? We study. While others are scrolling or chilling, we dive into the fundamentals. That's how we stay ahead. So let's talk ROE. So you've probably seen people talk about ROE, but what is it really? ROE stands for return on equity, and it tells us how good a company is at turning investor money into profit. Think of it like this: you give a company $100, they make $20 profit. That's 20% ROE, which is great. So they make $2, that's 2%, pretty weak. Lose money, negative ROE. That's why I always check this before putting money into a stock. So why ROE matters? Here's the thing, ROE shows real efficiency. High ROE, smart, efficient company. Low or negative could be risky. Debt, poor management, or weak business model. But here's a crucial point for early stage or penny stocks like Dvlt. Sometimes a company has negative ROE today because it's investing heavily in growth, building tech, expanding globally, or securing strategic partnerships. That's not always bad. In fact, if the business executes well, negative ROE now can turn into massive upside later. You just have to know the story behind the numbers and weigh the risk versus reward. So example, Nbis and Dvlt. So take Nbis. Their ROE is roughly sitting at 5 to 8% right now. Positive, some profit, but volatile. Good example of a company starting to generate returns, but still investing in growth. Now think about Dvlt. Penny stock, negative ROE, but huge upside potential. If it executes on global growth and strategic deals, that's where smart investors shine. Understanding why ROE is negative and if the growth story justifies the risk. So here's a habit for you. Weekends are for studying. Markets close? Perfect. Check ROE, cash flow, revenue growth, debt, and also understand the growth story. Is negative ROE just a phase due to investments? Are there real catalysts for growth? Make this a weekly routine. Every weekend you study, you're sharpening your edge. You'll be ready to make smarter moves when markets open instead of reacting blindly.